Welcome, savvy investors and financial freedom seekers. Today, we're diving into a hot topic that stirred up quite the debate in personal finance circles: the Ramsey Show's advice on wealth building.
Second thing is you got to get out of debt. Your most powerful wealth building tool is your income. And when you spend your whole freaking life giving your money to banks who fill up the skyline and have furniture nicer than yours, that makes you stupid.
Is paying off debt before investing always the best route to financial prosperity? Let's unpack this, exploring why a one-size-fits-all approach might not suit everyone. So buckle up as we navigate through the intricacies of leveraging investments over paying down debt. Dave Ramsey, a household name in personal finance, advocates a straightforward principle: pay off your debts first, then focus on investing. His method emphasizes the psychological uplift and the security that comes from being debt-free. It's a strategy that has helped countless individuals regain control over their finances. But is it the best path to building wealth for everyone? Imagine you have a loan with a 3% interest rate. Meanwhile, the market, say an MSCI ETF, offers a 6% return after fees, commissions, and taxes. By focusing solely on debt repayment, you might miss out on a 3% net gain from these investments. Over time, thanks to the magic of compound interest, this difference can significantly impact your wealth. Now, onto leveraging. Leveraging means using borrowed money to enhance potential investment returns. It's a strategy as old as the market itself and not without its risks. However, with low-interest debt and a well-diversified investment portfolio, the potential for wealth growth can far outweigh those risks. This method requires a nuanced understanding of risk management, but can be a powerful tool for financial growth. Personal finance is just that, personal. As we conclude our discussion on the traditional advice of prioritizing debt repayment over investment, particularly in the context of a mortgage, it's crucial to recognize the evolving financial landscape we find ourselves in. The past decade and a half have been characterized by an exceptionally low interest rate environment, prompting a reevaluation of conventional wisdom. While the security of being debt-free is undeniably appealing, it begs the question: in this unique economic climate, might there be opportunities for greater financial growth through strategic investment? This brings us to the heart of our analysis. We've meticulously compared two distinct financial strategies over a 30-year horizon to assess their potential outcomes. On one hand, we have the traditional approach of aggressively paying down mortgage debt. On the other, a strategy that leverages the low interest rates to invest excess income, meeting only the minimum required mortgage payments. Our methodology was grounded in historical data and robust financial modeling. We utilized mortgage interest rates sourced from 30-year historical mortgage rate data to ensure realism in our debt repayment model. Investment returns, modeled on the performance of the MSCI Index, reflecting a diversified investment portfolio to simulate the investment strategy outcomes. As you can see in the chart, the blue line representing the scenario where all the debt is paid back first. There is no uncertainty, a smooth line until the investor is debt-free and starts investing in volatile assets. The orange line, where the investor starts investing at time zero, has more volatility, but in this simulated case, a higher net worth at the end after 30 years. The value of the parameter, like initial investment, do not really matter. The only thing are the expected values and the uncertainty parameter that matter. Due to the fact that we have randomness, we ran 100,000 simulations for both scenarios. Engaging in 100,000 simulations provided us with a spectrum of potential outcomes for both scenarios, revealing critical insights into expected returns and associated risks. As we move forward to share these results, remember, while the higher expected return of the investment-focused strategy might catch the eye, it's the nuanced understanding of risk, as encapsulated by the Sharpe ratio and other metrics, that will guide informed financial decisions. The histograms and distribution plots derived from our simulations serve as a visual summary, illustrating the frequency or likelihood of various net wealth outcomes at the end of the 30-year period. Here's how to interpret these key elements. Bins. Each bar or bin in the histogram represents a range of final net wealth values. The height of each bin indicates the number of simulations that resulted in a net wealth within that range. Shape. The overall shape of the histogram gives you an immediate sense of the distribution of outcomes. For instance, a peak towards the left or right might suggest that most outcomes are clustered around lower or higher net wealth values, respectively. Spread. The width of the histogram reflects the range of possible outcomes, from the least to the most favorable. A wider histogram suggests greater variability in potential net wealth, indicating higher risk. The histogram and distribution for Scenario A, focusing on debt repayment before investment, shows a narrower spread, indicating lower variability in outcomes. The peak towards the lower end of the net wealth range suggests moderate returns with reduced risk. For Scenario B, where excess income is invested, you observe a broader histogram and a distribution curve with a higher mean, but also a wider spread. This reflects the potential for higher returns, but at the cost of increased risk, as indicated by the greater range of possible outcomes. The table complements the insights drawn from the visual analysis by detailing the quantals of the distributions, further elucidating the spread and central tendencies of the outcomes for each scenario. Notably, the Sharpe ratio, presented in the table's last row, serves as a measure of risk-adjusted return, where a higher value denotes a more favorable return-risk balance. According to the parameters defined in this analysis, an investor might find a marginally improved position opting for Scenario B. Nevertheless, it's crucial to acknowledge that our initial assumptions, which significantly influence investment decisions, may not always be fully transparent or known to investors beforehand. By analyzing the histograms and distribution plots, we gain valuable insights into the risk-return trade-offs associated with each scenario. While Scenario B may offer the allure of higher average returns, it also carries greater risk, as evidenced by the wider spread of outcomes. Conversely, Scenario A presents a more conservative profile, with outcomes more tightly clustered around a lower mean, suggesting steadier but potentially less lucrative returns. This visual and statistical summary underscores the importance of considering both potential returns and associated risks when evaluating financial strategies. It highlights that an optimal choice depends not only on one's financial goals, but also on individual risk tolerance and the broader economic context. Dave Ramsey's advice provides a solid foundation, but it doesn't factor in individual circumstances like risk tolerance, financial goals, and the specifics of one's debt and investment opportunities. A more flexible approach, tailored to personal financial situations, might prove more beneficial for some. Imagine Sarah, an IT professional with a stable job who has a low-interest student loan. She opts to invest in high-yield ETFs while making minimum loan payments, positioning herself for significant financial growth. Then there's John, who followed the debt-first strategy, finding peace of mind in being debt-free but missing out on early investment opportunities. These stories highlight the diverse outcomes of different financial strategies. The psychological benefit of eliminating debt is undeniable. It offers a sense of freedom and achievement. However, from a purely mathematical standpoint, investing while managing low-interest debt could lead to greater financial prosperity. This dilemma between emotional satisfaction and financial optimization is central to the debate. Embracing a strategy that combines debt management with investment requires discipline and a commitment to financial education. Understanding the market, knowing when to invest, and recognizing the right debt to retain are skills that can be developed. This approach empowers individuals to make informed decisions that align with their financial goals. So, what have we learned? Dave Ramsey's debt-first advice has undoubtedly transformed lives, offering a path to financial stability. However, it's clear that a more nuanced approach, considering personal circumstances and market opportunities, might better serve those on their journey to wealth building. Leveraging investments while managing debt can be a viable strategy, provided it's done with careful planning and a solid understanding of the risks involved. Remember, the path to financial freedom isn't a one-way street. It's a winding road full of personal choices and strategies that reflect our unique financial landscapes. Whether you choose to tackle debt head-on or navigate the investment route while managing loans, the key is to stay informed, make decisions that align with your financial goals, and always keep an eye on the future. Thank you for joining us on this financial deep dive. Whether you're a steadfast Ramsey follower or a curious investor exploring all avenues, remember that your financial journey is uniquely yours. Stay savvy, invest wisely, and here's to building a future of wealth and stability on your terms. Don't forget to like, share, and subscribe for more insights into making your money work for you. Until next time, keep pushing forward on your path to financial freedom.